Source code speaking. OG John XX here. Markets are closed. It is Saturday. And if you've been following this channel the past few weeks, you already know what that means. Weekends are not downtime. They are when the structure of the coming week begins forming underneath the surface. We go through the data, we track the flows, and we watch the signals that most people do not notice until after the move has already happened. If you are paying attention, drop OG in the comments. Do not skip ahead. Whew. What I cover later in this breakdown ties several pieces together that most analysts are still treating as unrelated stories. They are not unrelated. They are parts of the same system moving at the same time. Silver closed the Western trading week around $84. But the number that matters is not the Western closing price. The number that matters is what the physical market in the East is willing to pay for that same metal. Shanghai is currently pricing physical silver near $96. That places the premium of Eastern physical demand over Western paper markets at roughly 14.6%. And the direction of that spread over the last several sessions has been consistent and directional. 13%, then 13.4, then 13.8, then back above 14, now sitting near 14.5. That pattern is not noise. It tells you exactly where the strongest demand for physical metal currently exists. Here is the layer underneath that number. Physical silver continues leaving the COMEX vault system. Institutional buyers have been standing for delivery session after session, removing metal that was previously counted as available supply. Registered inventory has been trending lower as a result. At the same time, something equally significant is happening on the demand side of the Western retail market. Retail participation is still almost completely absent. The Sprott Physical Silver Trust continues trading at a discount to net asset value, roughly 5 to 6% below the value of the underlying silver it actually holds. That tells you Western retail investors are not chasing this move yet. For anyone who understands market structure, that contrast matters more than the price level itself. In 2011, during the last major silver bull cycle, the Sprott Trust carried an average premium above 17% across the year. Investors were paying significantly more than the underlying metal value just to gain exposure. Right now, the situation is the opposite. Institutions are quietly accumulating physical metal, while retail investors remain on the sidelines. That means the move is not being driven by speculative enthusiasm. And when retail eventually notices the price and returns, the shift from discount to premium becomes an additional multiplier layered directly on top of the metal price itself. Now step back from the metals market and place this inside the broader macro picture, because none of these signals are happening in isolation. Oil crossed above $100 per barrel this weekend. Not every benchmark has confirmed the move yet, but Oman crude, which is the primary pricing reference for Middle Eastern exports into Asia, moved above that level first. When Oman moves, the rest of the benchmarks tend to follow. That matters because oil is not just another commodity. Oil sits at the center of global logistics, agriculture, transportation, and manufacturing costs simultaneously. The reason oil is moving is not complicated. The Strait of Hormuz remains under heavy tension. Shipping lanes have been restricted for certain vessels connected to Western markets. Military activity in the region has escalated again. Multiple naval assets have repositioned closer to the Persian Gulf. And the strategic implication is straightforward. Even limited disruption around a major energy choke point produces immediate price reactions across the entire global system. At the same time, Qatar declared force majeure on a portion of its liquefied natural gas exports following operational disruptions at one of its largest facilities. Qatar supplies roughly 20% of global LNG markets. When that amount of supply is interrupted, the impact does not stay contained to a single region. Europe is particularly exposed. Since losing access to cheap Russian pipeline gas following the Ukraine conflict, European energy security has depended heavily on imported LNG. A significant share of those shipments now comes from the United States and Qatar. If Qatar supply tightens while global oil prices remain elevated, Europe faces a situation where both primary energy channels are becoming more expensive at the same time. Gas prices across the region have already started reacting. Industrial energy costs are rising again. And if those costs remain elevated for weeks rather than days, the conversation shifts from temporary price spikes to permanent industrial consequences. Facilities that shut down during prolonged energy shocks do not always reopen. This is the exact trap that macro analysts studying supply-driven inflation described years ago. When price increases originate from energy supply disruptions rather than consumer demand, traditional monetary policy tools become ineffective. Raising interest rates cannot create new oil supply. It cannot reopen restricted shipping lanes. It cannot produce natural gas that does not exist. What it can do is slow economic activity while the supply shock continues pushing prices higher. That is precisely the dilemma central banks face when energy volatility and geopolitical tension intersect simultaneously. Now bring China into the picture, because this is where the metal story deepens considerably. The People's Bank of China has increased its official gold reserves for 16 consecutive months. The latest edition brings total holdings above 74 million fine troy ounces, month after month without interruption. That type of accumulation pattern is not tactical hedging. It is strategic reserve reallocation. Central banks do not buy gold consistently for over a year unless they are deliberately adjusting the long-term composition of their reserve base. Global central bank buying has slowed slightly at the start of this year, according to the World Gold Council, with net purchases in January running below the previous 12-month average. But China did not slow. China continued purchasing. That consistency matters because reserve allocation decisions made by major central banks reflect long-term geopolitical and monetary considerations, rather than short-term price movements. Gold itself continues holding above $5,000 per ounce in Western pricing. Eastern demand remains firm. And the geography of that demand mirrors the same pattern we identified in the silver market. Strong buying concentration in Asia, while Western retail participation stays muted. When both gold and silver show the same directional demand pattern across regions, that alignment is rarely accidental. Return to silver for a moment, because one of the most significant structural changes in decades is currently unfolding, and almost no mainstream coverage is addressing it. For years, silver consistently held the distinction of being the commodity with the largest concentrated short position relative to available supply. That dynamic allowed paper futures markets to dominate short-term price discovery. But over the past several months, large commercial traders have been reducing their short exposure at an aggressive pace. The commitment of traders reports show that positions 5 through 8 among the largest commercial traders now hold the smallest short positions ever recorded. The 4 largest traders still maintain significant short exposure, likely concentrated among a small number of major banks. But the broader commercial short structure that historically applied selling pressure during rallies has been shrinking rapidly. When the institutional entities that traditionally capped price momentum begin reducing their positions, the structural ceiling on price discovery weakens with them. That does not mean the market moves in a straight line from here. Paper markets still control the majority of short-term price movement. A sudden ceasefire headline, a sharp move in the dollar index, or algorithmic liquidation across commodity markets can still push silver lower quickly. COMEX leverage remains elevated. There are still several paper ounces trading for every registered physical ounce available for actual delivery. That imbalance allows short-term volatility to remain significant and unpredictable. But structural shifts unfold slowly until they do not. Physical supply deficits in silver have persisted for multiple consecutive years. Industrial demand continues expanding through solar energy, advanced electronics, and precision manufacturing. And when institutional short positions begin shrinking at the same time physical inventories trend lower, the long-term implications become increasingly difficult to dismiss. One additional detail worth noting before the new week begins. Tokenized gold and silver markets operating through blockchain-based platforms continue trading over the weekend, while traditional exchanges remain closed. These markets are not perfect reflections of physical pricing, but they provide directional sentiment signals in real time. Currently, those prices are holding close to Friday's closing levels, with only minor upward pressure. Nothing dramatic yet, but worth monitoring as an early indicator before Monday's opening. Here are the specific signals to watch as the week approaches. Watch whether the Shanghai silver premium holds above 14% or continues its expansion. Watch COMEX registered inventories to see if the physical drain persists. Watch oil benchmarks following Oman crude above $100. And watch central bank gold purchase data from China, because consistent reserve accumulation at this scale tends to reveal long-term monetary positioning well before markets fully price it in. Every data point discussed here is publicly available. COMEX inventory reports update daily. Commitment of traders reports release weekly. Central bank reserve changes come directly from official institutional statements. Verify the numbers yourself. Always verify. Markets reward patience and discipline far more reliably than they reward hype or reactive emotion. The system leaves signals everywhere for anyone willing to look carefully enough. Most people just do not slow down long enough to find them. OG out.